Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for the next 25 minutes on Options Guide TV. We've got quite a few trades to look at, and I do want to get in. We do have some residual earnings that are being announced, and one of the companies that I'd like to look at today is Micron Technology, MU. But had a real solid move up recently. The fundamentals are strong in Micron Technology, and now in the tech space, semiconductor space, we're seeing a little bit of more movement in the industry. NVIDIA's having a good day today, and Broadcom. All of the semiconductors in this space seem to be doing strong. Got some upside momentum. We're going to look at a trade in MU, but before we get there, we got a lot of positions on. As a matter of fact, we have way too many positions to try to manage. The first one is a sad one. USO, we are down on oil, and we put a trade in, and I want to talk about an adjustment to the trade. Now, on Options Guide TV here, a lot of times we're really just trying to, I guess sometimes we learn more from a trade that has gone against us than a trade that has been positive. And, we're only trading 3 days a week, Monday, Tuesday, Wednesday at 11 a.m. Eastern time. So on the USO vertical spread, now, first of all, when the market opened up, because this is a news-driven scenario, on Tuesday morning or whenever everything started to slow down a little bit in the oil, and it was fairly apparent that the news was perceived that oil would go down based off of the news, and it's based mainly off of the fact that there's a ceasefire, and it's perceived that it's possible that the conflict might be over, right? So the price of oil started to drop precipitously. At that point in time, you should get out of the trade, especially on a shorter term trade in a position like this. I'm not looking to usually adjust it. We put it together because we got a really solid skew. There was definitely a skewing of the volatility smile to the upside, actually leaning way more bullish than bearish, but it's news driven, right? The news is what brought the stock down. So let's now run to the Tradier Pro software, and this is the put vertical, but this isn't the. I got it in backwards. 1 second. Let's go and send this to the ticket, and we'll take a quick peek at it. And send a ticket. 1 second, and I'm just going to show you a possible adjustment on a trade that has gone against you, but it's not for the light of heart, because you got to be somebody that watches the trade, watches the market constantly in order to want to do something like this, because you are going to be short two spreads, and one of them would be assigned if you didn't close it out. So in the USO, the trade that we have on currently is the July 2nd expiration. We sold, the market was around 82, 83, and we sold the 80 strike and we bought the 76 strike. Almost a 50-50 trade, which was, we got like $4.50 or $2. What, this is 4 points right wide. Let me look and see exactly what we ended up getting, because it was a really good fill because of the way the skew was in the market. Yeah, we got $1.23 on a 4-point wide spread, and when we put the trade together, that was the other day. We got $1.50. We ended up getting $1.50 on this trade. And we were about 3 points out of the money. So that was a really solid risk reward on an out of the money short put spread. Okay. The market has gone down. What the alternative would be here is, when the market started to creep south, is take some risk off the table by rolling this into an iron butterfly. And I'll explain that, because I don't know if I've gone into great detail about it. You can roll it into a butterfly if you would like to, but it's going to cost you money to do it. If you do an iron butterfly, you already have the margin out. If the marketplace goes down, right now your margin requirement would be $4. But if you adjust it and you say, okay, the market's going down, let's do a bearish trade, and we're going to end up selling the 80 strike and buying the 84 strike. Now, here's I wouldn't want to do this now because the market's already moved too much. But this is basically an iron condor, right? But we're selling the same strike in the middle. So it's actually called an iron butterfly. And if you go to my website, optionsplaybook.com, and you type in the word iron in the search bar, one of the strategies that would come up would be an iron butterfly. So you can bring in a net credit to the account, and it doesn't cost your position anything. Now, that means you have a butterfly on, and all you're trying to do then is, once again, the phrase I like to use, I don't want the cheese anymore, just let me out of the trap. You are hoping that the market comes back, lands somewhere within the middle strikes, and you can be fairly profitable on this trade if it lands somewhere in that range. Now, that also means, though, that you're going to probably have to pay something to buy it back, right? You're going to probably have to close out that position, just like on a short spread. But now you have two short spreads that are on. Here's where the concern is. As opposed to a butterfly, where if the market just goes against you, everything can just expire worthless. You got to be cognizant of the fact that you're short two spreads. One of them is going to be in the money. And if one of them is in the money, there's an exercise and assignment that can occur, right? Even if they're completely worthless, you might get exercised and assigned. So you want to close this out. You just don't want to have to deal with it, especially if you're in an IRA account, and mainly because there's a lot of brokerage firms out there that might do something weird to your account because you're short this spread as expiration approaches. They might manage the risk differently than you would. Let's put it that way. So with that mentioned, that is the alternative. You sell the short put spread, the market starts going down, it's trading with somewhere next to your long strike. This is always a trigger point for me if the market's going against one of my short spreads. And then you sell and roll this into an iron condor or an iron butterfly if you want to. Now, that's possible to do that trade. You don't have to do it. And you don't even have to sell the same strike. You could sell the 81 strike and buy the 85. But if you do that, that means you're an active trader. You're not going to do this and then go to work for the whole day, right? You got 7 days until expiration. You need to watch this type of position if you put something on like that. But the market has gone against us. We did this trade for about $1.50. And right now, if I remove this, it's 4 points wide. So you have 50 cents. So would have closed it out when we're down about $3, when this was trading for $3, where we would have to buy it back and pay about $3 net debit to the account to close the position. Okay. And this would be the close. We would be buying the 80, selling the 76. It's a $3.50 net debit to the account. When we put it on, it was we swapped it out. All right. Any questions on this position? So now the question is, if you had it on, the market's moved solidly against you. It's obviously news based. The ceasefire could be stopped tomorrow, and maybe it goes back up. That would be horrible news. It'd be a horrible way to get the trade back to profitable. But it's news based. So if you have a potential catalyst that could drive the market back up in the oil prices. So do you want to risk the 50 cents because the maximum this thing that you can lose on the trade is 50 cents? Or do you want to play the hope game and hope that the market starts coming back? Oil is obviously, it dropped precipitously. It was not, I guess I did not think that oil would move that quickly to the downside. Obviously, we put the trade on. But that it would drop that precipitously to the downside. Now, also did a USO trade and did very well on the trade prior to the event. And that was all based off of the chart and where oil was going. The chart was kind of hinting for some reason that the price of oil was going up. Okay. Next, SPX. So now we got an SPX trade on. And to go along with the oil, for some reason, this is real positive in the marketplace, and we're pushing up against all-time highs. So if we have the what-if calculator on here, we were doing so well over our earnings reports, but this trade isn't doing as well either. Let me send this one to the ticket. And it's mainly just because of the timing of it. SPX right now, 6,095. And it's Wednesday. If this is Friday, this is a wonderful position, but right now it is Wednesday. And because of that, we're going to be down on this position. We're going to add to send it to ticket. And there we go. And it's 450. Okay, so we put this on for $1, maybe even a little bit more than $1. Market came up. It's sitting right where we want it to sit, right at 60.90. But with this trade, now remember, this is as of today, so all of this is kind of screwed up. The profit and loss graph and everything is kind of screwed up a little bit. But with that said, this is where we want it to land, is right in this range, and we've gone through that strike. So right now I would close it. I would just get out of the position. If it hits your short strike, treat it as a short spread, just like you would a short spread. We have the buffer in of the butterfly, and it's giving us some protection, but it's not giving us a ton of protection, right? It's not on Friday, this position, you'd be like, woo, we're right at the middle strike. That's wonderful. But time premium needs to decay in order for this to be a wonderful trade, if you will. So we put it on for $1. We're down $4 on the trade. We'd close out this trade and we'd move on. Okay, and I do see a couple of questions, so let me address the question. Thank you, Andrew, for your question. Rookie here, my reaction to the USO trade, USO price move would have been to close the option by buying it back because I don't know the seasoned veteran strategies. Do you add more options to losing? Well, that's a great question, and that is the right answer, by the way. If the market does move against you, there is absolutely nothing wrong with closing it out and saying, once again, if I'm in a short spread and the market ever gets to my long strike, right, my protection, that means that option contract is now an at the money option contract. And that's when you're going to get the most juice you can possibly get for that option, right? Because you're like, oh, I'm wrong, but now I get to sell my long option and get all the premium of selling an at the money option contract. So I'm always going to consider just closing when you get to that position. That's always a viable way to get out. Not to mention, you can just look at the price and say, we put it on for $1.50. It's now trading for $3. We lost the $1.50, the maximum we could have made on the trade. We're going to close it out and we're going to get out of the position. That's a very viable way to trade. Now, I gave an alternative, which is an advanced alternative, where you just roll it into a butterfly. And I've done this in a lot of my trading where you start out in a butterfly and you roll it into a short spread, or you start out in a short spread or a long spread and you roll it into a butterfly. So you're just kind of playing games. The biggest thing about the trade that I showed you just now, Andrew, is that I'm not adding any more additional risk because the market can only go up or the market can go down. So I end up in a position where I am short a call spread and I am short a put spread. Put spread wants the market to go up. Call spread wants it to go down. There's no more additional capital that I put on the trade. And I bring in a net credit to my account, which will offset my risk a little bit. So it's an advanced trade. There's no doubt about it. And like I said, the warning here is that you'd be short two short spreads and you need to close them out before that expiration or something. You don't want to leave it up to the brokerage firm to close it out because somebody's going to get exercised on the sign because you are short two short spreads and either the market's going to go up or the market's going to go down. So to start with, I think you are correct, especially in the beginning, is to just close out trades. A lot of people want an adjustment. And the right answer most of the time is just close it. Just close it and get out of the position and move on. All right. And then we have an Amazon long butterfly, and Amazon is up a little bit. This is our last position that we have on, and the market is moving against that. In that, it's moving fast, but there's no real concern in this scenario at this point in time. Let me send this one to the ticket. And that's mainly, we put it on, midpoint net credit is 33 cents. We put it on for 20 cents. We're down 13 cents. But ultimately, if we do this trade, we want Amazon. Amazon has drifted higher. It needs to drift higher slower, right? Ultimately, when we get to that expiration date, we want time decay to occur. We're looking at the 18th 7/18 expiration, and yeah, that's simple. We just don't need it to move that fast because the green line is where the profit and loss is at now. That will eventually start morphing into, and let me scroll down a little bit. That'll start morphing into what it looks like at the expiration date when we put it on. Okay. And then lastly, and go ahead, you can put Andrew's comment out if you'd like. I appreciate that. Yeah, I like it when people participate in my reindeer games. So if you have any questions, especially about trades that we have on, I'm more than happy to try to address them. Now let's do another trade. Now I wouldn't have this many trades on inside my portfolio if I was doing this. I've already traded the SPX trade, and I did have that position on, and I mentioned that on Monday's show, and I've already gotten out of it. As soon as it hit the short strike, I was out. I lost a little less than if you did it today, but I did have that position. And I really didn't think with the geopolitical concerns that we have going on right now that we were going to bump up against new highs. But for some reason, everything was perceived as, I guess all the problems went away because Iran's not going to get a bomb. I don't quite understand why that has driven the markets up so much, but it has. It is what it is. And then so you got to say thumbs up, right? Everybody's 401ks are doing well. Next, but my trade didn't do well. The market can be brutal sometimes. MU. I've had MU in my account for quite some time. Finally, the marketplace has woken up and said, "Oh my gosh, this is a good stock," and they're announcing earnings at the end of the day. Strong chart. And that's the only thing that really concerns you here. Come on, charts. Let's get going. And that's the biggest thing that concerns you here is that, RSI is showing a little bit above 80, trading around 82 or so, and showing a little bit of the overbought conditions. Come on. Oh, I am froze. But what I want to do is I want to look at a skip strike butterfly and MU. Now, it's not a very high price stock. We can still get it done for a decent price, and we got the risk of a gap opening. I'm going to use the short term expiration, but if you want a little bit less risk, you could go out another week. Man. Wondering if I got to turn it off and turn it back on. Yeah, good idea. Let's try it. And I like this trade. Like I said, I've owned Micron in my own account, just shares of the stock. There it goes. Okay, we can come back. This was the USO position. Here's Micron. And this is what scares you the most, is just the strong move to the upside. Now, if we scroll out in time, we are not at all-time highs. I still think the stock's got some room to run. Trades at a solid PE, and the forward PE is lower. Strong earnings growth. Micron, it's just things are looking good. But this was 100% a breakout right here. And if you bought right there, you've done really well. Now we're at earnings. You're a little nervous because we've had such a move to the upside. And if they don't outperform, there's some risk to the downside. Or if that wasn't the case, I would be looking to either do a bull call spread or even buy a call outright or do some type of scenario. Probably a bull call spread is what a trade would be. But now I think we're a little bit tippy. So I want to sell something, bring in some premium, and see if the marketplace does get to that area. And I'm going to look at, I'm going to start with the June 27th expiration, which is 2 days away. They're announcing after the close today, you have all day Thursday, all day Friday, and then the position would be done. We're going to look at about a 1 standard deviation move. We got 1 point strikes. So we can bring in a decent amount of premium. The delta is 19 on this one. We're going to buy, sell 2. And you're bringing in quite a bit of premium here, right? So 33 cents. We're bringing in $2, and this is $1.30. Then we're going to skip these 2, and we're going to buy this one. And 140, 142, 140 here. 14-cent net credit. Okay, so we have 2 points of risk. We're bringing in 14 cents. My goal would be to get 20 cents. Usually 10% of the risk is what I'm looking for on these trades. So the risk is from 42 to 44. That's where the short spread is on our skip strike. That's 2 points wide. There's going to be a 2-point margin requirement. So if I'm looking at this trade, ideally I would like to get this done for a 20-cent net credit. I don't mind the 14 cents that it's trading at right now. And you're going to have 2 days. If the market does not move the 1 standard deviation move all the way up to the 142 level, if it hangs out right within the range, the expected move was around $10 on the position. So $10 from here, puts you at 135. So this is where the expected move is at, plus or minus 10 points. So they'd have to go more than the expected move and go about a 1 standard deviation move based off of implied volatilities. There's a 16% chance of it doing that. Now, this is an earnings report. So we all know that these are the numbers that we're quoting, but earnings definitely throw in a huge twist as to the potential movement. So your biggest concern on a 2-day trade is that the market actually gaps open and opens somewhere around 142, right? It opens all the way where you actually have risk to be lost and you don't have any way to trade out of the position on the way up. All right. I like these trades better if they announce on a Thursday, because then all you have is Friday. I mentioned many times on this show that Amazon always does that, but I don't mind this trade. If Micron hadn't made such a strong move to the upside, then I would consider just doing a long call spread. But now I'm just, I'm going to do a few of these. Mainly because we're only bringing in about a 10 cent or a 14. Well, it was 14. Now it's 13. I really would like to get that to be 20. Maybe even think about adjusting down 1 strike to see if I could get it done for 20 cents on a 2-point wide trade. But we're going to leave it there. We had the stalling out issues. So now we're back. Let's go look at 1 more week out, and then we might be able to go an extra strike price. Let's look at the July 8th. But now remember, this is going to move. The 140 is going to move because the gray area is going to move out a little bit. Let's look at the July 3rd expiration, 140. 140 is 140 on this position is 16 delta. 140 on this position is 20 delta. Okay, 20% chance. We'll go down a little bit more. Let's look at, well, let's stick with 140. Let's keep it there. Let's go buy and sell 2. So that's 242. Oh, too many. Buy, sell 2, skip the 144, buy 146. 15-cent net credit. So you can move it up to 140 and start there, but I'm still not getting a 20-cent net credit. Really wanted that to be 20 cents. All right. I like the shorter one better because we're not getting more of a credit here. Let's move it down. Let's go down. Let's try this one. 130, sell 2 of the 140, skip the 142, buy the 144. 30. Oh, of course, I screwed that up. Yeah, there's the 20 cents. All right, we'd have to move it down 2 points to get to the 20-cent level. I still like the shorter term one. I like the June 27th expiration, 2 days away, trying to get around 14, 15 cents net credit as opposed to going an extra week and getting a 20-cent net credit. And those are going to be the trades for this week. I don't see any other questions or concerns. And thanks for stopping in. Micron earnings tonight. We'll know by Friday how the position panned out. USO right now, just close out the trade if you put that position on. SPX, just close out the trade. Once it hits your short strike that fast, just want to get out of that position and not let it run against you hard. Your max risk is $10 on the trade. We're able to close it out I closed mine out for around $3, put it on for $1. It was a solid trade. I still like the trade. It just didn't pan out on the short term. Market was just too positive after the news over in the Middle East. VIX is all the way down. Yeah, VIX came all the way down to 17, which kind of helps that trade out a little bit because of the short options. But yeah, that's where I'm just gonna let it go. That's it for today's Options Guide TV. We'll be back on Friday at 11 a.m. Eastern Time for the next edition of Options Guide TV, and we'll see how the Micron Technology Skip Strike Butterfly works out. Thanks for stopping in, and we'll see you soon.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.